Whenever you notice the price reversing near a certain level like this on the chart during live trading, you mark a support zone right below it. Whenever the price gets rejected around a level and tries to move downward, you draw a resistance zone and wait for either level to be broken. As soon as the market breaks the level you've marked, you take a trade in the direction of that breakout. However, instead of yielding profit right after entry, the market often hits your stop loss. I'm sure this scenario keeps occurring again and again, but have you ever questioned why this happens repeatedly, or what the real reason behind it is? Most traders, assuming it's just market noise, rush to find another entry without understanding the actual cause. This repeating pattern keeps them from making consistent profits. That's why, in today's video, we'll explore the crucial price levels you need to focus on while analyzing charts during live trading. So, let's understand how to identify key levels on the chart. But before we move ahead, if you find this topic valuable, make sure to hit the like button. And if you're here for the first time, don't forget to subscribe and turn on the notification bell so you never miss our latest updates. I'll see you right after the intro and disclaimer. It's a 5-minute time frame chart. After a gap up opening, the market is trading around the psychological level of 26,000, forming this price action. Now, how would you interpret the price movement on this chart? Pause the video for a moment and think about it. Based on my understanding of trader psychology, many of you would likely mark a support zone below this point, as the price has bounced strongly upward from here. In addition, the market has shown 2 rejections at the higher side. Hence, you draw a resistance level here in the support area below this zone, as the market hasn't moved beneath it. If your chart analysis looks similar, share it in the comments. Once you've drawn these key levels, you then wait for a breakout above or below. As soon as the breakout happens, you plan to enter a trade. For a beginner trader, this kind of analysis seems almost accurate. However, a professional trader, when analyzing the same chart, doesn't just plot support and resistance zones, they also study the price behavior occurring between these areas. For example, when the market reversed from the bottom and moved up for the first time here, strong bullish green candles appeared on the chart, showing a demand zone at the lower levels. But when the price first faced rejection from higher levels, it quickly moved up again after identifying a fair value gap. Yet, failing to surpass the previous high, the price turned downward. Looking at the candlestick formation, when the price initially rose from this zone, it gained around 50 points within just 3 bullish candles. But the second time it reversed from this level, it took the market nearly an hour to cover that same 50 points. Whereas before, it did so in 15 minutes. This shows that bullish strength has completely faded here. Even if the market breaks the resistance area, a pro trader would avoid entering a buy trade on that breakout, because according to their analysis, there's no bullish momentum left, making the breakout more likely to fail. Both beginners and professionals may observe the same chart differently. The difference lies in the approach. A beginner, like you, typically observes price movement and draws lines for support and resistance without exploring the reason behind those moves. Meanwhile, a professional trader, studying the same chart, goes deeper, not just marking zones based on price action but also examining the candlestick patterns, understanding the market psychology, and observing how price behaves around key levels and where major points of interest are forming. Now, what exactly is a point of interest? Let's quickly understand this as well. Points of interest are those zones on a chart where buyers and sellers are the most active, meaning they show a strong desire to take positions. In other words, these are levels where traders prefer to execute trades rather than anywhere else on the chart. Examples include supply and demand zones, support and resistance areas, chart patterns, equal highs and lows, trend lines, and round number levels, basically any region where a large number of participants are actively trading. These areas are known as points of interest. For instance, in this chart, the price is showing strong reactions around these 2 zones. This means that points of interest have formed near these levels, and retail traders are paying more attention to these areas. However, since the market often creates fake breakouts around such points to trap retail participants, professional traders remain cautious here. Take this example, the market has broken out near this resistance zone. A strong bullish candle appears to indicate a breakout. Seeing this, many traders assume it's genuine and enter long positions. But shortly after, that same bullish candle reverses and turns into a red candle, trapping all the traders who entered long at the breakout. That's why, whenever a level breaks out in this manner, you should avoid taking trades until you get confirmation of the breakout. A pro trader waits patiently because they know this level has been rejected twice before. As the price moves closer to this area, the candlestick structure clearly shows that buyers have weakened, resulting in smaller candles and a noticeable loss of momentum. Therefore, the chances of a genuine breakout are minimal. Later, when the price drops sharply, forming this kind of price action, professionals become active again. This time, the market has fallen quickly from the resistance zone, unlike before, when it took longer. Moreover, the fair value gap that appears here doesn't hold for long, suggesting that sellers are dominant and actively offloading positions. Hence, this setup provides a good opportunity for a short trade on the bearish side. Shortly afterward, the price drops rapidly. There are two approaches to trading this price action. If you're an aggressive trader, you can take a short position right on this red candle and place your stop loss above it. But if you prefer a safer entry, you can wait until the market breaks below this level, forms a fair value gap, and then produces a rejection candle. This setup is called a confirmation trade entry. In the same way, a professional trader, after carefully analyzing the chart and reading the price behavior, takes trades calmly and consistently makes profits. Meanwhile, a beginner trader, without fully understanding the price movement, jumps into trades impulsively and ends up facing losses. Therefore, trade entries should always be made by identifying and respecting the key levels that form on the chart. Let's now understand which key levels on the chart you should focus on. Key level number 1 is the supply and demand zone. Whenever the price moves toward a certain level in the market and repeatedly gets rejected from it, that region becomes a supply or demand area, depending on the price direction. For instance, if the price rejects from lower levels and turns upward, we refer to that region as a demand zone. Likewise, if the price rejects from higher levels and drops, it is identified as a supply zone. Buyers dominate the demand zone, while sellers control the price in the supply zone. Therefore, whenever the price enters either of these regions, you can find strong trading opportunities. For example, in this chart, the price declines from the top and forms lower highs. This indicates that the market is repeatedly failing to break its previous high. It shows that sellers begin selling again whenever the price attempts to rise, preventing it from crossing the earlier high. Hence, we can mark the supply zone on the chart and wait for the price to revisit this area. For instance, in this example, once the price rejects from the lower side and enters our marked supply zone, we can open a short trade here. We can set our stop loss above the supply zone. Shortly afterward, the price rises, rejects from the supply area, and falls sharply. Many traders overlook this setup simply because it doesn't involve any complicated strategy. You just identify the supply zone and take trades accordingly. As a result, traders often ignore this powerful entry setup while chasing advanced trading strategies in the market. Yet this setup can provide reliable trade entries every single day. For example, I've used the 5-minute time frame chart to explain this setup. If you check the chart of the following, you'll notice the market rejecting from our supply zone and then falling sharply. Additionally, you can apply this setup again on that day. When the price drops here on the chart, it pauses around this level for a while before moving downward rapidly. This indicates that sellers are selling aggressively in this region, creating a strong supply zone on the chart. Also, this zone has not been tested yet, making it a fresh supply area. As soon as the price comes near this zone the same day, it rejects again and falls, giving us a significant profit. Hence, you cannot overlook this trade entry setup. Similarly, just as the supply zone works, the demand zone works the same way. For instance, if you examine this 5-minute time frame chart, the market formed a rejection candle and surged upward from the lower levels. This shows buyers are actively buying in this area and don't want the price to fall below it. Thus, this region acts as a demand zone for us. And if the price rejects this level the next time, we can take a long position here. Therefore, once the price enters this zone and forms a rejection candle on the chart, we can enter a long trade. Shortly after, the market rises and hits our target. Likewise, if the market rejects from the lower levels in this way and then moves up sharply on the chart, We can mark the demand zone here. After some time, as the price returns to this demand zone, it reverses and rises again, continuing to trade above it. Any trader who missed entering long earlier can take a long position once more when the price forms a fresh demand zone. If the price comes back here in the future, they can enter again. Whenever the price reverses before touching the previous demand area, it signals that buyers are very strong at this level. The market prefers buying at higher prices, forming a new demand zone. If the price returns here, it may reverse instead of dropping further. This is why a trade can be taken in this area. Key level number 2, liquidity area. This is the 5-minute time frame chart. After a sharp decline, the market reverses from the lower side and forms price action on the chart. A demand zone has developed below, and a supply zone has formed at higher levels. Now, when the price rejects from this fair value gap the second time and moves down, a fresh supply zone is created here. Whenever supply and demand zones appear on the chart, a large number of retail traders prefer to trade around them. This builds liquidity around these areas, which is crucial for price movements. Now, as the price moves down again, it appears ready to break its previous swing low. Instead, it reverses and creates a fake breakout near the supply zone formed at the higher levels. After sweeping the liquidity created by retail traders, it drops again and then consumes the liquidity around the demand zone at the lower side. Similarly, when the market opens, the price first moves down after sweeping the liquidity created by sellers in this region. This means whenever supply and demand areas form on the chart, liquidity also develops around those zones. You must make your trade entries with this in mind. Only then can you avoid getting trapped in such false breakouts. Because here, the market has broken both of these resistance zones from the previous day. Seeing this, many retail traders instantly enter long trades without thinking. This is completely wrong. These breakouts are designed to trap you, and they appear so perfect that traders can't resist taking them. You may have witnessed such ideal breakouts many times, setups that look flawless and meet every condition, yet still fail and trap you. That's it, traders. Thanks for watching. If you're watching this, it means one thing: you haven't given up on yourself. And that already makes you different. If today's video fueled your mindset, press like, and if you're new, subscribe and hit the bell so you never miss the motivation that keeps you moving. Remember, you weren't made for average, you were made for more. So rise above the excuses, rise above the fear, rise above the doubts. Your future self is waiting for you to show up. Keep going, and I'll catch you in the next video.